Welcome to Corporate Finance. Okay, in session number 8, we're going to look at how do we value stocks and how is that different than the bond valuation we just concluded. Stocks are a little bit harder to value. We don't know the coupon or the dividends. Dividends are unpredictable, whereas the coupon is pretty well set at the beginning. Coupon rate is set at the beginning of your stock or bond purchase. Dividends can go all over the place, so a little bit more difficult to value a stock. And what are some of the formulas? In my hands, I have an old stock certificate. So back in the early days of the market, you used to buy, let's say, 100 shares of IBM. You get a certificate like this that says you owned 100 shares of IBM stock. If you wanted to cash that in, you had to sign the back of it, flip it over, sign the back of it, and then send it in to the paying agent, and you'd get your check maybe a week or two later. Now, you go into Fidelity or Charles Schwab, you say, sell 100 shares of IBM at the market, good for the day, and about 10 milliseconds later, your cash is in your account. So things have changed dramatically from the old days of stock certificates, but it's kind of neat to learn the history of these stock certificates. How do we value a stock? Here are the learning objectives. What are some of the formulas? So in Chapter 7, we basically have one formula to value a bond. Now we have 3 or 4, and there are many other ways to do stock valuation analysis and also merger and acquisition analysis. The complex forms, discounting cash flows, doing income statements, balance sheets, and cash flows for 5 years and projecting them out, and then discounting them back to today, adding in a terminal value if it's an acquisition, and valuing the company that way. We will use some simple, this is an introductory course, we'll use some simple common stock valuation models, basically 3 or so to be exact, and we'll see how to determine the worth of a stock. We'll also look at some features of common stock and preferred stock. How is preferred stock different than common stock? And what are some of the key components of a preferred stock versus a common stock? And finally, stock markets. Where do we buy our stocks? Where do we buy our IPOs? Can we buy IPOs? And where do we get our secondary market transactions, which is generally where you and I play in the stock markets? And where exactly do we buy these stocks and how do we buy them? We're going to talk all about these 4 things in session number 8. 3 key formulas to valuing stock. There's the general stock valuation formula. I call it the wildly fluctuating stock valuation formula. If your dividends are wildly fluctuating, or the required rates of return are wildly fluctuating, or the G growth rates are wildly fluctuating, we need to use this equation to value our stock. Then we have a second model, zero dividend growth, which is the same dividend forever in perpetuity. We hope that company that pays that dividend lasts forever and will pay that dividend forever. And it's simply the present value of a perpetuity. If you remember Chapter 6, C over R, price of the stock is equal to D over R. Okay, instead of C, the constant cash amount, it's just that dividend over R. So same exact formula we learned in Chapter 6. And then if we have a constantly, this example was company that used this valuation model was General Motors. For years and years, they paid $2 every single year, $2, $2, $2, $2, and never changed. And then we had a financial crisis in 07, 08, and General Motors and Ford and Chrysler almost folded. They were in very difficult situations, and eventually they stopped paying that $2 dividend. So they couldn't use that model any longer, but for many, many years, that would be the way to value General Motors stock. And then also constant dividend growth. If your dividend is growing at a certain constant rate, a G, each and every year, McDonald's comes to mind. Their board of directors wanted to increase their dividend 4% per year for 5 years. That was in some of their financial statements and financial goals. They wanted to just increase at a constant 4% dividend rate. They did way better than that in those years involved, but this is the way you would value McDonald's stock, which had a constant dividend growth rate, G, of 4%. Supernormal growth equation is the same as the general case, and all it is the present value of the dividends in the future discounted back to today using Chapter 6, and then the price at some time t in the future, and then also discounting it back to today. And that P sub t is equal to D sub t plus 1, over R minus G. Now, D sub T plus 1, the next dividend is equal to D sub T times 1 plus G. It's just 1 year out. And then finally, I can break up that equation directly above it into the components of required return, solving it for R. How do I solve for R? R is equal to D1 over P0. That's at D0 times 1 plus G. And then solving for R in that equation, I just add G. So dividend yield, D1 over P0 plus G, dividend growth rate are the two components of required return. Again, thinking back to McDonald's stock, if you want to think about that stock, what do you require when you buy McDonald's stock? You want it to grow in price. That's G, capital appreciation. And you also want that stock to pay you a dividend or have a dividend yield, D1 over P0.